Welcome back. In the last 3 days, there has been panic buying and scrambling for essential commodities. This is in reaction to the near state and national lockdown measures. The strategic associate at the financial derivatives company, Aisha Dawood, joins me now to talk more about the impact of this on the economy. Good afternoon, Aisha. Now tell us, what will be the impact of panic buying on headline inflation for the month of March?
It is true that we have panic buying currently. The average prices of commodities, domestic commodities, have spiked by 30%. That is very, very alarming. People are buying excess of what they need. Let us note at this point that this near lockdown is for non-essential domestic commodities, not for essential. Essential commodities like food staples, medical pharmacies will still be operating. So people are buying in excess of what they don't need. And this is what's causing a disequilibrium in the market, making prices of things to go up than expected. Then we have the price surge. So if this excess buying should continue, people are panicking because of, the pandemic that is happening around the world and even in Nigeria now. If this excess buying should continue, headline inflation would be very, very impacted significantly. Currently, we have headline inflation numbers came out earlier in the week, and we have it at 12.2%. If things are not taken into consideration, if people are not buying more than what they need, headline inflation would rise above that, because food inflation makes greater than 50% of headline inflation. So food inflation and headline inflation move together concurrently. If food inflation to spike, headline inflation would spike. And we can see that food inflation is, coming up because prices in food staples are increasing. So headline inflation is going to increase beyond normal for the month of March.
A decline in the CBN Purchasing Managers Index for the month of March by 7.2% to 51.1, compounded by a sharp drop in federal allocation disbursement, will result in lower consumer disposable income. Now, what will be the impact of this on aggregate demand and GDP growth in the first quarter of 2020?
Major revenue income for Nigeria is from crude oil. Oil prices are falling and declining. It's currently $20-something per barrel. And that's our major source of revenue in Nigeria. We can see this, that the federal government allocation, the fact disbursement has declined by 10%. Fact numbers came out yesterday, and you can see this sharp decline has reduced the money available in circulation. The money given to each state to, pay salaries for their civil servants and people that are working for government, they have limited money to spend. That's why we can see decline in the consumer disposable income. They're not able to buy what, they need to buy to afford, and they can afford. And if this should continue, if this should continue in Nigeria, if the PMI numbers are also contracting, if the PMI numbers to keep falling, the allocation, the money we have to spend keep falling. Nigerian government is currently spending a lot on medical government, on medical, so that we can prevent ourselves from this COVID. And the aggregate demand is made up of all this: consumption, investment. People are barely investing now. Everybody is hoarding money because they don't know that the fear of uncertainty is alarming and is causing a disruption in the economy. So if these uncertainties, people keep, thinking of uncertainties, and they keep they're causing disequilibrium in the market. Consumption is relatively increasing because demand is increasing and they cannot afford it. Then investment is not increasing. Government spending is increasing, but not on capital projects that would boost the economy. Aggregate demand is going to fall. Aggregate demand and GDP growth rates are very also concurrent, like they move in the same direction. A fall in aggregate demand will be expecting a very, very slow GDP growth for Q1 2020.
I said quickly now, if the COVID-19 pandemic continues until the third quarter of the year, how will it affect aggregate economic output, employment and prices? Could this possibly result in an economic recession?
I would say we won't think about it. A further, lockdown on essential activity of the economy we're going to have a slump in the economy. economic activities will slow down because business activities will not go. Inventories that are already stocked will not be able to replenish. The economy will start contracting. PMI numbers will start falling below 50. And when a PMI number starts falling below 50 points, the economy is in chaos. We are heading for, recession, if possible. But a recession is oncoming if our economy should slump, because employment is going negative already. If this should further extend to Q3 in 2020, it's going to be affecting the employment numbers. We'll be having negative employment. Prices will start flattening out. Economic activities will be negative or just stagnant. And that's not a good, booster for an economy like Nigeria.
Aisat Dawood, Strategic Associate at the Financial Derivatives Committee. Many thanks for sharing your thoughts with us. In other news now, global ratings agency Moody's Investor Service has commended the Bank of Ghana for reducing its benchmark lending rate to 14.5% and other risk mitigating measures. According to Moody's, the action will provide cash flow relief to borrowers and improve repayment capacity, but will also decrease banks' asset quality. Ghana is also seen affected by a global slowdown in travel and tourism, as well as international trade. A projection likely to lower non-oil commodities as demand slides. The service also assigns a B3 positive rating to Ghana Commercial Bank, noting that its gross loans to total asset of 29% will help limit the negative effects of coronavirus on its asset quality. And South Africa's economy is expected to come under increasing pressure as it enters a 21-day national lockdown from today, ordered by President Cyril Ramaphosa in response to the spread of COVID-19. Meanwhile, South African Reserve Bank on Wednesday launched a bond buying program seeking to drum up demand in credit markets as the coronavirus epidemic weighs on the country's already ailing economy. The country's bond market has been in short of buyers since February, while daily sales of sovereign debt have regularly topped 4 billion rand or $230 million, including a record 12.8 billion rand on March the 2nd. The SARB says it would buy bonds of varying maturities in the secondary market and expects the move to boost the take-up of government debt and make it easier for commercial banks to fund their operations. Meanwhile, the African Export-Import Bank is creating a $3 billion credit facility to help African countries overcome the effects of the coronavirus pandemic. Afrexim Bank says in a statement that the Pandemic Trade Impact Mitigation Facility will help countries avoid trade payment defaults, support foreign exchange reserves, and assist commodities exporters struggling with declining revenues. The pandemic is expected to strain Africa's under-equipped health systems. Many African countries are already reeling from declining oil and commodities prices, and weakening local currencies are making it more expensive to service foreign currency-denominated debt. And oil prices were mixed today following 3 days of gains, with the prospect of rapidly dwindling demand due to coronavirus travel bans and lockdowns of certain hopes of a US $2 trillion emergency stimulus will shore up economic activity. Brent crude futures rose 0.4% to $27.51 a barrel, while U.S. crude futures slipped 0.2% to $24.45 a barrel in early trade. Analysts say with lockdowns in many countries, expectations of oil demand contracted by more than 10 million barrels per day are rising, and such demand loss will increase the supply cuts. And that's where we end today's program. Many thanks for watching. I am BC Adebayo.